All right, guys, welcome back. Today I have a case. This is for educational purposes only. It's not personal, financial, or investment or tax advice. It's one, though, that I have conversations with clients often. And really, my goal with this video is to present a case where a fictitious couple is considering doing a Roth conversion. So they have a sizable amount of money in pre-tax qualified accounts, and they're looking at should we or should we not do a Roth conversion. Now, what I'm attempting to do in this video is I want to provide some context for some common content that you're going to see on YouTube. So really, there's two things that I see, and really what I'd like to do with this channel is to try and fill in some gaps of how do we actually think through and solve problems for a client instead of just telling you that you should do a Roth conversion and here's why. I want to actually walk through an actual case. So I'm going to combine two common themes that I see on YouTube amongst financial advisors, CPAs, etc. And I want to try and actually walk through the case. So the two strategies are this. One is going to be the Roth conversion, which I mentioned. The second is going to be utilizing short-term rental real estate as a tax offset strategy. So these are two sides of a coin. When you do a Roth conversion, you are essentially taking out money of your pre-tax account that's been deferred. You're paying the taxes now in order for that to be converted to Roth so that you will never pay taxes on it again, subject to rules around qualified distributions. Concurrently, if you have short-term rental real estate, and I'm going to walk through the rules and how that might work, what you can do is you can do a strategy called cost segregation, where you take a property that you own and you essentially split it up into its components. And if it's a residential property, instead of depreciating it over 27 and a half years, you can split that depreciation so that you get a very large amount up front. And you have to combine that strategy with something called bonus depreciation. So what I'm going to do is kind of walk through the different nuances of this case. Hopefully it's helpful. This is a 2024 case, so we are now in 2025, but I want you to know that the principles in here are still going to apply, so the numbers will not be exact, but I do want to try and give you as much actionable information about how can we actually go about thinking through this. Hope it's helpful. If you're watching this, love to hear your comments and subscribe if you like this kind of content. So here's our case. We have a husband and wife, and they are age 60, and they are concerned about taxes in retirement. So as you can see, I'm going to start to highlight the pieces of this case. So their combined 401k pre-tax accounts are 2.2 million. And so they, being at age 60, want to retire, but they know that by 75, they're going to have to start making withdrawals from that account. The problem there is the required minimum distributions will then be much larger, assuming that growth happens in the account between age 60 and 75, and they want to try and mitigate that. So there are a lot of factors that go into play here, but the video at hand is meant to just walk through, okay, they've already decided they're going to do the Roth conversion. So we're taking that off the table. It's not what this video is about. That could be a subsequent video or another video. This is about, you've already decided that is the action you're going to take. And how do I figure out a strategy to offset that? So knowing that these taxes are going to come, you are forcing taxes into the present in order so that when they're spread out over the future, they will be less. It's a lifetime tax strategy. It's not a one-year tax strategy. So what's going to happen is over the next 5 years, they're going to be working part-time. They're going to go from a joint income right now of 300,000, which puts them in the 32% tax bracket. That would be for 2024. And from ages 60 to 65, they're going to have a combined 80,000 income. So they're committed to living on a pretty modest early retirement salary while they try and do some tax strategies. Now, just so happens that they have either already acquired a short-term rental property or they want to acquire a short-term rental property. And so what I've laid out for you here is, in addition to their pre-tax account, they have a taxable brokerage account that is valued at $500,000. Now, again, this assumes either they already have the rental property or they've decided to utilize some of this or savings to acquire a short-term rental property. They also have $150,000 in a Roth. All right, so we've already defined the problem, but let's define it a little bit more. assuming that their IRA value between 60 and 65 continues to grow at a 5% annual rate, they will have 2.8 million. If that were to continue until age 75, this would assume an adjusted real rate of return because they would probably begin doing some withdrawals. It would still be over 3.4 million. That means at age 75, assuming there are not extenuating circumstances that apply to them, their required minimum distribution every year would be 139,000. Now, that doesn't sound like a problem, right? So someone who's living on 80,000 might like the idea of, well, let's just live on 139,000. That's fine. Now, here's the problem. That is forced income, but they have other income sources. So say this couple at age 75, now this inflates, okay? So this assumes that they have a combined Social Security amount of about $50,000 in today's dollars. You have to inflate that for 10 years. That's going to go up to $150,000. Now, if I click into this here, basically you can see 50 to 150. They also have a pension. So meaning either one or both spouses have a pension. And so really what they're going to be forced to do is they're going to be forced to live off $364,135. Now that is where the tax bracket becomes an issue. And so we don't really know what's going to happen to tax brackets in the future, but currently if we're betting and thinking we have a country with a very, very large deficit, we have a problem with funding of Social Security, a lot of people would put their bets on the fact that taxes might raise in the future. Now, again, don't know what that tax rate would be. So I was assuming that in the future that would represent either a 22 tax rate, potentially higher. And so that's our problem. So really, what do we do? What are our options? So the conventional option would be you just do Roth conversions every year. So maybe you do a little bit and you do them every year until before you reach at age 75 to try and mitigate those RMDs. The problem is all those amounts are going to be combined with your other sources of income. So an alternative strategy might be, this is more of a short-term strategy. You would only do this between 60 and 65. And especially I'm going to model for you here a year one. Okay, this is a 1-year strategy that I'm showing you. Would be you combine this short-term real estate strategy with the Roth conversion so that you could do a very, very large conversion up front. And then potentially you may or may not choose to actually do more conversions. So here's the strategy. And I broke this down into steps. There are going to be 9 steps in this process. And as we go along, I'm just going to explain the relevant topics. So step 1, you either buy the short-term rental property or you've already acquired it. Again, I'm assuming this cost about $300,000. This would be something that you would need to think about beforehand. So this would be from a combination of a savings or brokerage account. Now, where you decide to do this is very important because currently there's a law that was passed with the TCJA, which was in 2017. It's set to expire at the end of 2025. And basically it introduced the concept of bonus depreciation. So under the IRS tax code, that is going to be also known as 168 in the code. And I believe I have that in the spreadsheet here. I will show it to you in a second. But basically what that means is normally when you depreciate property, you're going to do it over a longer period of time. But if you elect that, you can elect from the time that was passed up until 2025, there's been a decreasing percentage amount that you can elect for bonus depreciation for properties that are short-term rentals that are business related. Now, currently that sits at 40% for 2024. And so with Trump's election, he has proposed, that was a Trump election tax bill. And so there's a lot of talk about bringing back 100% bonus depreciation. So this is actually going to assume that we can do a 100% election. But I want to be very clear, right now, that is not allowed under the tax code. But it's very possible that that could happen in the next year or two. So I want to show you, because that makes the strategy a lot more appealing than getting a 40% upfront deduction. Basically, what bonus depreciation allows you to do is whatever deduction that you gain, you can actually elect to do that all in 1 year at a certain percentage. So basically, The reason I say the state matters is because certain states have not elected to honor the federal mandate of bonus depreciation, meaning the states also do not recognize it. So it's much more beneficial if you do it in a state that it does allow for this. So step two, you have to materially participate in this short-term rental. So for most rental real estate, say that you just have a real estate property and you rent it to a renter. Maybe it's a long-term renter. You're not actually gonna be able to offset that income against your ordinary income because the IRS has basically split income into passive and non-passive. And so if you were to have a normal long-term rental that is not something you materially participate in, therefore you're not going to be able to offset strategies you use personally for that purpose. So it can get very complicated, but I want you to understand that we have to follow certain rules in order for this to even get off the ground. And so usually there are seven basically, there are seven material participation rules. I'm not going to go over them in depth in this video, but really one of the most common ones would be the average stay needs to be 7 days or less for the renter. That's why short-term rentals are good for this. And you have to meet one of the rules about how many hours you participate. And so this is going to range um, anywhere from 150 to 750, depending on what strategy you choose. Now, if you're a real estate professional, so this is really helpful for a couple where maybe one is working full time and there's a spouse that's either raising kids or they just don't work much. That person can get a real estate license, and then the rules are much, much easier for real estate professionals. That's where you would fall under that 150 hours a year in terms of which you materially participate. Or another common rule is that that person doesn't participate any more than anyone else, meaning they do the most hours out of anyone. So if you have a cleaner, they do less hours than you do. That makes sure that you materially participate. So I want to be clear. You have to clear that with a CPA to make sure that you are materially participating. So let's move on. What are your income and expenses? I just created some here. So I assume that you have yearly income from this rental property of 27,300. The expenses don't aren't too far behind because you got to pay cleaners, you have to put furniture, whatever it may be for this first year. So your expenses, you're not making a ton on this, okay? So your net income is 5,300. Now, that doesn't mean your cash flow is bad. It just means that at the end of the day, this is your net income on paper, okay? So what you would do is you would choose to do a cost segregation study. You're going to have to get with a group. There are groups that do these. They need to be professionally done. They also involve engineering analysis. So you want to make sure you hire the right person to do this. And basically what you can say is instead of depreciating this property over a full 27 and a half, you're going to break it down into the components. So let's think about what's in a house. There is, there's a roof, there are doors, there are windows, there are cabinetry, all the parts of the physical structure. You can break them down. And then basically whatever you're able to cost segregate, you can aggregate that amount. Okay. So basically, if you look at this, say this house is 300,000. Here's the math. I'm going to highlight the columns. You cannot do cost segregation on land, meaning it has to be subtracted from the amount. So we're down to kind of 250 here. And then basically what you've got to do is you've got to cost segregate what's called 1245 property and 1215 property. Again, I'm not going to go into the details here, but that's just from the IRS. So you can still do 27 and a half depreciation alongside of the cost segregation, but it's really only what you gain from doing that cost segregation. And so what I did here is I just took a 30%. Okay, so I just took 250 and I took 30% of that because everybody's cost segregation study is going to be different. Not everyone's going to get the same amount. That's just kind of a rule of thumb here. Okay, it could be 25%, could be 40%. I decided to use 30. And so what we're going to do is we're going to take that 75% and we're going to elect, again, there's the election is called 3115, to take the bonus depreciation on the 1245, which is what we did for the cost segregation. And so that allows us, again, this assumes, I want to be very clear, this is a 100% amount. So I want to just say, again, backing up to 2024 for a second, if you're able to do this at 40%, that number becomes 30, just to be clear. So I'm utilizing 75 because it's more advantageous in this case, and it's very possible that Trump could bring back 100% bonus depreciation. All right, so that being said, I'll come off of that and erase that not to confuse you. So step 6, you have to unlock that deduction against your income. That takes us back to material participation. Are you doing the right things in that year to make sure that that upfront deduction can actually go against your income? Okay, so let's assume you did that. Again, beyond the scope of this video, but let's assume you did that. And so what I'm writing here is just saying, okay, we have our net rental income of $5,300. We have our regular income from our jobs of 80,000. So this is kind of our total. We took advantage of some things in order to help us out. And so we decided to fund an HSA this year at 8,500. That puts us somewhere in the high 70s range. So basically that allows us to do an above the line deduction below this amount. And if you're doing this, you're not going to be able to elect the standard deduction. So basically I just put a line here for other deductions. It's blank. But basically we're able to take this entire 75 and we're able to net it against this. Okay. And so what we're able to do here is basically our taxable income becomes next to nothing. Okay, so it basically goes down to 1,800. And so then we basically have almost zero tax, $180 for the year. Okay, now here's why that's important. Because you just took your normal income and with the cost segregation, you almost took it down to zero. Well, guess what? The best time to convert on doing a Roth conversion is when your tax bracket is at the lowest, right? So essentially you're starting from the floor. So you just kind of layer on top of that a Roth conversion. What I've done is I've taken the tax brackets from 2024 and I've just looked what would it take to kind of fill up that 24% tax bracket, and it would be close to this. Now, normally when we talk about Roth conversions, we're talking about the marginal tax rate of the conversion. But realize with this strategy, we've pretty much wiped you down to zero. So it's as if saying you're doing a Roth conversion, and you are, but really it's saying you actually made this much income, right? Because all the other income just got wiped away from all the other things we did. And so this would become kind of your new gross amount, right? That you would end up having effectively. Okay, it's not how it would work exactly, but I just want you to follow me here. And so we have a progressive tax system. So instead of just using a marginal rate for that conversion, that's going to filter through all of the tax brackets. So that's going to take you up, and basically you're going to pay on that conversion somewhere around $77,000. Okay. So what I did here is I took this and I basically took the balance of what our previous amount was, and I'll just kind of scroll over so you can see that highlighted. So I took that 2.2 and said, hey, we did this big conversion. What's our new pre-tax balance in year one? Well, it's 1.8 million. That's a big difference. Now, here's what's also cool is we already had $150,000 in Roth, remember? So we just added 382. So all of a sudden, just like that, we have $532,000 in a Roth. Now, here's where this gets important. Let's take that 1.8 million and let's just let it grow. Okay, let's just say it grows for five years. That's what I'm doing here at 5%. That then becomes 2.3. Now, that's much lower than it was before. But conversely, you've got a Roth growing beside it. So this one I put Roth's usually a little more aggressive for people because they pull it last. So I put it at 6%. That's 712. So all of a sudden you get to age 75, you have over $1 million in a Roth from doing a 1-year massive conversion. Okay. Now, in this case, at age 75, you're at 2.8 million. Now, here's where I want you to see. This is your actual RMD amount. I skipped over this before. This is based off the uniform life tables in order to do a required minimum distribution. And so the RMD would be 114,000, right? So remember what it was before. It was projected to be 139. So right off the bat, you're saving 24,000 of those dollars that you don't have to pull. You don't have to pull them at all. Okay. Now, in reality, the savings is not exactly that because the savings would be whatever the tax rate would be at the time when you pull that 24,000. But assuming that, I just want you to kind of mentally get your head around that. So then you would just perform some form of break-even analysis. This becomes really hard because, like I said, I'm not actually using the tax amount. I'm just using the dollars. And so if we went from 114 to 139, just using those amounts, this would be roughly a three-year break even. So meaning if as long as you live to age 78 or 79, you did pretty good by doing this conversion. Because remember, you saved not only on individual tax, but you saved on the conversion itself. So if you would have not done that strategy at all, you would have had to pay 14,000 more dollars to do that conversion. And that's out of pocket. So 14,000 more. So really we're talking almost $20,000 of savings just by doing that in 1 year. Now, this is kind of where this ends because I don't want to get too nitty-gritty into the details, but I want you to see that the real benefit here is that by age 75, you would have over $1 million in Roth where you started at 150,000. Now remember, that's important because as you age, you lose the ability for compound interest over time. So this will be one strategy where you really leap ahead because you do a large lump sum Roth conversion in year one. Now there's a lot of caveats. How long are you going to live? How much money do you want to live on? What are your other income sources? That's why I created this is there's no silver bullet. So you can see this isn't a 100% slam dunk strategy. A lot of things need to fall into place, but I at least wanted to show it to you to give some nuance. So next time you curse over YouTube and you see a short or a video talking about short-term rental real estate and bonus depreciation, this is how it would actually work in practice if you're someone who wants to also do a Roth conversion. There's a lot more to it, but hopefully that was helpful. And I want to continue to do more videos like this so you just have more actionable insights about decisions you can make, how they impact you, how myself as a financial advisor would break this down. Hope it was helpful, and I will see you next time.